Boom. All right, what's going on, you guys? Royce Jacob here, and in this video, I'm going to be talking about why we could potentially be seeing a global depression, not just a recession, why I don't think you should be investing in stocks right now or buying into the equity market, and just a brief explanation as to what I'm investing in right now that I feel will do the best and perform the best over these tough times. Okay, so yeah, I'm just going to go over some fundamental and technical analysis. So this is a chart of the S&P that we're actually going to get to at the end. I'll go over the fundamental analysis first, and then we'll move on to the technical stuff near the end of the video. Okay, so this is the first thing I wanted to talk about, all right? And this is the single thing that I think will have hands down the most negative impact on our economy, and I feel like it's very, very obvious that it will. Okay, so this is a CNBC article just released today. The title is "The Upcoming Job Losses Will Be Unlike Anything the U.S. Has Ever Seen," and it will, because pretty much the entire U.S. is shut down right now. The economy is at a complete standstill. Okay, so I'm just going to read through these key points right here that they mention. The first is the coronavirus crisis is likely to result in layoffs on a scale the U.S. has never seen before. 2, economists expect April to be the first reporting month when the damages start to show up. So that's, next month it's going to get real bad. Forecasts for April range from 500,000 to 5 million, which is a very large gap. But even if you just consider it's somewhere near the middle at like 2.5 million, that's greater than the world has not ever seen. It's close to the Great Depression, but it's almost like 4x 2008, which we'll get into here. Oh, right here, yeah. The worst month during the financial crisis saw non-farm payrolls decrease by 800,000. Exactly. So see 2008, 800K. Next month, potentially 5 million. So that is exponentially greater. And then the last is weekly jobless claims numbers are expected to be so bad that the White House has reportedly asked state officials to delay releasing precise counts. Okay, so that's when you really know it's going to be bad, is when the White House is requesting that they kind of blunt or dampen the numbers, just because it'll cause so much panic, as if there's not enough. I get why they're doing that. It is good to try to mitigate that panic a little bit, just because there's so much going on and so much emotions that are running high right now. But it's bad, guys. And when people aren't actually, you know what, here, let's go over this first. This is a chart I really wanted to show you guys that shows kind of the gravity of what when you put these numbers on a chart, this is what it'll look like. So this is a chart of jobless claims dating back from, what is this, like 1965-ish. So as you can see here, the crash of like actually I don't know if that was a crash, but here in the early 80s, it was pretty high. Around the same time, again, here's the financial crisis in 2008. That was 800,000 right here. So it peaked at 800,000, right? And you're looking at, again, 2.5 million on kind of the conservative side, or just maybe the standard side, 5 million on the higher side. So that would be way out of this atmosphere. So this is 2.25 million right here. And that's what that looks like in terms of 2008 over here. So again, that is exponentially greater. When people aren't working, people obviously aren't spending money. They don't have the money. They aren't buying luxuries. They aren't spending like they have been in recent times, right? So this, I feel like the biggest fundamental factor of this, and why I think the markets will fall into a depression and not rebound to anywhere near the previous highs that we saw, like just at the beginning of this year, for a very long time, is because this is emotionally getting to people, right? People now have fear in their hearts and their minds because of this. It's a traumatic experience that we're all going through, and literally the entire human race is going through right now. Okay, so I mean the bull days are really kind of, or like the extreme bubbly bullish days are kind of over, in terms of just overall market and investor sentiment, just because this is such a traumatic experience, and it will take a while, in my opinion, for just the sentiment, just the overall sentiment to ever be where it was at the beginning of this year, because we're on just such a high, and then this is such a really cataclysmic just dent in our psyche. So again, I think that's the most crucial fundamental reason that the markets will not rebound to previous highs for a very long time. So let's get into this last kind of fundamental. This is kind of bridging the gap between fundamental and technicals. So this is called the Shiller PE ratio, and this is covering the S&P 500. What a PE ratio is price to earnings ratio. So that's pretty much how much a company makes in earnings. So how much a company profits per year, and how money in correlation to how much people are paying for it on the market. Okay, so this ratio divides the price of the S&P 500 index by the average inflation adjusted earnings of the previous 10 years. Again, okay, so this is the price. Say a company's making this, obviously not, but just for the example, a company's making $1 million a year, and people are paying $15 million for the stock. So that's a 15 PE. That's 15 price to earnings, which is about that's about where you want it. Okay, so let's go here. Yeah, a 14 price to earnings ratio is the green right here. So you can see how this chart is kind of color coded. The green is where you want to be. The green is considered a fair price to earnings ratio. And then you can see here in the 2000 .com bubble is when it was by far the highest. So that's when all these new tech companies were popping up. All these just companies that were really just making anything they wanted and putting .com at the end of it. That's why it's called the .com bubble was going on. And that's why the price to earnings was so out of whack, because companies weren't making anything and being valued at ridiculous amounts. So it was at a 40 PE. That means people were paying, or what was the highest right here? It was like 43.7. Okay, so they're paying 43.7 times what the company's earnings actually were for shares in the company. And then now you can see obviously the 2000 bubble, very infamous. It popped, went down to about 20, so it went down 50%. We went down here. This is 2008. So at 2008, it went back into kind of what is considered fair territory at 14 to 15. And then here you see this last 10 years, right? This bubbling up over the last 10 years, where we've gotten back into this dangerous territory, like just call it 30. So we're at a 30 PE. So on average, for all the companies in the S&P 500 index, we are paying 30 times what the company is actually making and profiting, okay, for shares in the company. So that is very bubbled up, very, very overblown in terms of what is fair and what is considered fair. And just because we saw a 50% retracement here, just going by charts, and again, this is kind of bridging the gap into technicals, it would make sense that from 30, we pull another 50% retracement and then go back into the fair zone, which is 15. So that's kind of a double, like almost a double whammy for an argument right there. We're going to bounce, in my opinion, again, this is all my opinion, we're going to bounce back to fair valuation at about 15 PE. And then that is also, again, a 50% retracement from 30, which it is currently at. And again, I feel like that's more than reasonable because of just how tragic this actual situation is to our economy and how much this is blunting actual consumer sentiment. And people are just buying less, people are consuming less. That will happen for the foreseeable future until something very significant changes and turns the tides. Okay, so that's that. Let's get into the technicals. So let's go back to this that we opened on. So this is the SPDR S&P 500 trust, which is pretty much tracking the S&P. It's the most famous S&P trust. So again, this dates back from about 1994, just the beginning of 1995, my birth year. So this is tracking from 1995 when we saw this first almost tech bull run start. Okay, so we had this tech bull run, kind of slowed down over the 2000s. Again, this is the 2000 .com bubble where it popped, came down, took a long time to come back. So that was from the bursting of the bubble, August 2000 to May of 2007. So call that 7 years that it took to get back to previous highs from the .com bubble. And this went from about 150 down to call it like $80. Okay, so that's roughly a 50% retracement. You see these trends in these things, right? When something very catastrophic happens, like what is happening now, it is not going to be surprising, especially if things are super bubbled up and inflated, to see a 50% retracement. Okay, so you saw 150 down, dot-com bubble burst, back up in 2007 to about 150, almost exactly to the same top, which is pretty strange. Down again to almost the exact, let me minimize myself. Sorry. It's like just cutting it off. Okay. So again, came back exactly to almost exactly where it was, came back down to about the same spot at 70. So that's just over a 50% retracement. And then from 2008, that's when we started this crazy bull run, this crazy bull market that we've just seen that has been broken. And this is kind of the most important trend line that I've seen a lot of my peers drawing up, and I just drew up as well, because it is pretty much technical analysis 101. This has broken a very obvious and very important trend line, which is from when the 2008, the financial crisis, kind of slowed down, the market picked back up, and then again we started this 12-year bull run that we just closed off. So this trend line going up has held resistance and held support, I should say, for the last 12 years. Okay, you can see it's drawn up, it's touching every point. Every time it comes down to this resistance line or support line, it's bounced back up, and then we just broke that super hard with a red candle, which means that there is not even a chance that this comes back above this line, especially with the current economic climate that we're in. I think it's going to get much worse. Again, back to the 50% retracement thing, it is not going to be surprising at all to me if we do see a 50% retracement from the previous highs. So let's call it we're at about 330. That'd be 165. 165 level, which would bring us down just to above those previous highs. And that's another kind of TA 101. When something breaks trends so significantly and just crashes like this, it's not crazy to see it bounce back down to the previous high. So I would not be surprised at all if we bounce down to about 160, like 150s to 160s in a 50% retracement, just considering again how much of a bull run we've been on over the past 12 years. So historically, it's really not that crazy. It's crazy now just because, even to me, obviously I haven't been in the market for more than 12 years. Like, I'm 25 years old. But historically, seeing 55 or 50% retracements in the market is not by any means a crazy thing. So that's what I believe is going to happen. I think it will bounce up and down. It's not just going to be a straight shot down. It is going to have ups and downs, but I believe over the next few months, unless again something very significant happens for the better, and something very proactive happens, we're going to see a 50% retracement down to about $160 in the S&P. And I feel like, in my mind, that's inevitable. Obviously, it could not happen. I don't know this for a fact. But just almost every indicator in my mind is pointing to the fact that we're going to have a 50% retracement. So that is the reason that I'm not advising buying equities for sure. I do not advise trading this market. It is dangerous. Again, there will be ups and downs, or ups on the way down, but it is a dangerous game that we're playing. The markets are crazy. The future is very uncertain right now, which makes trading much more gambling. It's playing this market is gambling more than it is investing at this point. So if you want to play it, that's great. Do your thing, but it's just not wise in my opinion. Again. Okay, so that was that. This is kind of the last thing I wanted to show you guys, just because I thought it was cool. It's a little more abstract. So this is a Trading View, which is the platform this is TradingView, the platform that I use, and the people on there can share ideas, and this is one of my favorite guys. He publishes very almost abstract, unique ideas. His name is Bitfink. He's kind of low key, but this is a cool chart. So this is the DJI, Dow Jones Industrial Average Index. So this is going back to actually like 1966, which is way back. And this does a good job at showing you how good things still look, even though they seem bad right now. So we dropped. Currently, we're just about right there, right? Which is still way higher than we've been over past years. Obviously, inflation has taken place, and the dollar is worth less than it was, so prices are just going to be higher for everything. But I mean, still look at that. I would consider that a bull run in the macro trend. Definitely over the past 100 years, we've seen an insane bull run. But again, this will come back down to here, in my opinion. But regardless of that, or aside from that, this is a fractal pattern. So a fractal, if you're familiar, it's just a shape or a pattern that keeps repeating itself to make a larger version of itself, pretty much. So it's the same pattern repeating itself to make a larger version of itself, almost. And he drew up this fractal pattern that goes all the way to, what is that, 2049? Call it 2050. Okay, so again, it's not crazy if we see an intense dip like this. I think this might be a little drastic. It might get to this point just because the economy is realistically in a really bad place right now. So it wouldn't be crazy to see a retracement this severe. And then, again, like consumer sentiment, back to what I was saying initially, is so low. It's going to take a lot of investors, and it's going to take everyone some time to get over this and the pain that this has caused and the fear that this has caused and instilled in people. So it will take a while to bounce back, but it's very important to understand that this is a very long-term game. Again, it seemed the past 10 years have been so good and so bullish that it's kind of hard to imagine that this has happened many times before in history. And we're just going through the same cycle. Markets work in cycles, guys. So we're just part of a macro cycle, of a very bird's eye view cycle right now. And it's important to see it as that, and not just on the day-to-day. Don't focus on the day-to-day. That's important too. But in times like these, it's far more important to focus on the macro and see that things could get a lot worse prior to getting better, and they will get better. I'm overall an optimist for sure, but that's just the reality of where we're at right now. Things will get better. Again, you can see here, we'll reach new highs in 20 or 30 years, and that'll be awesome. And then we're back, and then consumer sentiment will have returned. But it definitely takes time for people to forget something as significant as this, and to want to put their money to work in markets that are so shaky and uncertain. Okay, so that's that. I told you guys I wanted to give you some insights on what I'm buying right now. So to sum it up, it's pretty much Bitcoin. It's Bitcoin and gold, safe haven assets that retain value well in very volatile markets. If you guys watch my previous videos, you know that this is what I am currently putting the majority of my wealth into right now. I have cash, I have Bitcoin, and I have gold positions, and then a few other small equity positions. One is Moderna, which is working on a coronavirus vaccine, which I feel like is obviously in times like these, companies who release that type of news and potentially release that type of product will do very well, because they're doing legit good for the world, and everyone is so emotional about it right now. So I see promise in that. It's a small position though compared to my Bitcoin and gold positions. That I feel like is the safest place to put your money right now, aside from cash. You want enough cash for sure, hands down. Make sure you have enough cash prior to investing any of your money at all right now. But if you do, I would store it in safe haven stores of wealth assets, hard money assets that will retain value when these markets are collapsing and when the economy is collapsing. Because right now, the only way we're gonna save this economy, to be honest, is by printing trillions of dollars and injecting into the economy, which right now, just because everyone is so hurting, we might go through a stage of deflation where the dollar gains value. But because we're pumping trillions of dollars into the economy, it will, over the mid to long term, inevitably decrease the value of the dollar. Okay, so cash is good right now, but over time, once people realize that the dollar is being extremely devalued, they will turn to store value hard money assets like gold and Bitcoin. So I do release a lot of videos about that, a little more in depth, but I just wanted to give you guys that if you're not familiar with my videos yet. So gold and Bitcoin, what I personally have my money in, and what I believe will do the best in these markets over the next short term is always questionable with every asset, but mid to long term, Bitcoin, gold, I feel like will kill it this year. Okay, so I appreciate you guys for watching. Always feel free to drop comments. I always love talking shop with you guys. And yeah, I'd appreciate it if you liked and subscribed too, if you want more content like this. Okay, so again, I appreciate you guys for watching. Until next time, peace.